Good morning and welcome to our Green Up TV. I'm really happy to be with you today for our second edition of our monthly broadcasting. Today, we will deep dive with our expert guests into transition planning and discuss around how to reconcile the endgame with the needed agility imposed by uncertainties, with a special focus today on the case of the automotive sector to illustrate this question. But before that, as usual, let's start with our highlight of the month. First of all, as most of you may have noticed, we are living a water and ocean sequence coming to a peak with the ongoing third UN Ocean Conference, the UNOC, taking place as we speak in Nice this week. While the blue economy is not a new theme, but 2025 might be a breakthrough year, bringing massive attention and awareness on the topic. Plenty of angles tackled over the last few weeks, such as plastic pollution, biodiversity protection, water security, or ocean preservation. But one matter drew our attention: water resilience. Indeed, during the Global Water Summit, so this is the annual flagship industry-leading water sector event, which took place in May in Paris, resilience was the key word on this year's edition. All comes from the impacts of global warming on the frequency and the intensity of floods and droughts, as we can see from this NASA GRACE analysis. By 2030, the global water demand will exceed available resources by 40%, so significant efforts are needed to ensure both water availability and its quality worldwide. The capital spending on water resilience is expected to grow from 41% in 2025 to 46% in 2030. And the cost of water security is expected to increase from $3.5 trillion in 2025 to $20 trillion in 2040. This resilience topic is on all representatives' agenda. For example, we can mention the large-scale projects at international level, such as the Jordan Aqaba project, which is the second largest desalination plant in the world, as well as the publication of the European Water Resilience Strategy on June the 3rd, and the 5 billion Portuguese water strategy as a good example of local planification. Many investors confirm their interest in blue economy, as the financing solutions mature and the investable ocean solutions proliferate. But they are also reminded that this asset class is at its early days and a lot of work needs to be done, particularly in terms of regulation and standardization. Acting for water cannot be disconnected from acting for the oceans, as protecting the full water cycle is key to ensuring this long-term water resilience. We can also mention the Blue Economy and Finance Forum, which took place in Monaco at the end of last week, bringing together actors from the finance and the economic sectors to discuss key challenges in transitioning to a sustainable and regenerative blue economy. 25 billion euros in investment are already identified, but additional 8.7 billion euros of new commitment have been recorded during the forum to accelerate the ocean transition, covering various areas, such as the decarbonization of maritime transport and ports, the restoration of marine ecosystems, marine energies, or biotechnologies. While the UNOC is not meant necessarily to engage countries to take commitments, like a COP will do, we do expect some key outcomes, and we'll surely come back to it in our next Green Up TV edition. Our second news today. The European Commission proposed on May 21st to postpone by 2 years the application of the battery due diligence obligations to allow the economic operators placing batteries on the EU market to be better prepared. This regulation on batteries, initially published on July 2023, establishes comprehensive standards for battery-related products within the EU to prevent and reduce their adverse environmental impact as well as on human health, from a life cycle perspective, so from the design to the waste management and the reuse of batteries. The Commission is considering that battery raw material supply chains are particularly affected by a shifting geopolitical landscape, which leaves the battery industry with many challenges, in particular related to the sourcing of these raw materials. This is then the time necessary to analyze and to adjust the supply chains accordingly. So the deadline for complying with these new rules will be pushed by 2 years, so from 2025 initially to 2027, offering also more time for the setting up of third-party verification bodies. This proposed amendment is part of the Omnibus 4 simplification package, published also on May the 21st, aiming at cutting red tape, reducing costs, and modernizing EU rules. But this proposal also reminds us the ongoing debate on the Corporate Sustainability Due Diligence Directive. So finally, our last news of the month, the International Energy Agency, the IEA, published its annual Global Critical Minerals Outlook on May the 21st. This new report includes a detailed assessment of the latest market and trends and their implication for the critical minerals security. In this report, the IEA identifies concentration of the extraction and production of critical minerals, particularly for nickel and cobalt, and mainly in China and Indonesia. The demand for key energy minerals continued to rise in 2024 and is expected to grow rapidly in all scenarios, driven particularly by the energy sector. The demand for lithium rose by almost 30%, and for nickel, cobalt, graphite, and rare earths by 6 to 8% in 2024. The lithium demand should be multiplied by 5 to 2024, following the stated policy scenario. The IEA emphasizes promising technological innovation as a lever for reducing this concentration of supply at every stages, from the extraction to the recycling, including the use of artificial intelligence, new production of synthetic graphite, and arc plasma recycling, for examples. This report might be useful for investors in assessing the innovation strategies of companies in the sectors, and particularly in terms of sustainability. Let's move now on the figure of the month. 2. This is the ratio of investment in low carbon related to fossil energies in 2024, according to the IEA's latest World Energy Investment 2025. This report shows that investment in low carbon energies cumulated $2.2 trillion, while the fossil fuels investment reached $1.1 trillion. So on one side, some regulations are being postponed, some supply chains are affected by a shifting geopolitical landscape. But on the other one, the total investment in low-carbon energies are taking the lead on fossil fuels. But is it enough? Is it ordered and efficiently planned? Is it strengthened by current uncertainties? Without further ado, let's move on to our topic of the day. Our experts will deep dive into our question around transition planning. Hi, Leisa. Leisa, I'm really happy to host Leisa Cardoso de Souza. You are an expert from our Green Hub Center of Expertise and Innovation. With you, we'll start just to understand transition planning. Again, we see that climate talks are evolving and are leading to many different buzzwords, like we were speaking about climate finance, then low carbon, net zero. Now we heard a lot about climate transition plan, even transition planning. So can you help us to understand a bit more this notion of transition planning and why we suddenly heard a lot about that?
Thank you, Laurie, for the introduction. It's a pleasure to be here. So I think it's important to explain to our audience that there is a transition planning process, which is the internal process in terms of developing a low carbon roadmap. And the transition plan is that external facing document. And why are we talking about it now? So why a bit of the buzz? So if we go back to 2019, we see this surge of net zero commitments and entities saying we'll reach net zero by 2050. But there was a question in terms of what's the plan? How do you get to that end goal? So this is why we're talking so much about transition plan, because it's really moving from the pledges to the action. And this comes from investors and also regulation. So if we also look at how it's being framed now in terms of you do the planning, you have the disclosure element, and then you implement. So if we look at the voluntary part of the disclosure, we can tie it back to the Task Force of Climate-Related Financial Disclosures, which alongside of disclosing the risks and opportunities, it's also saying and recommending that you publish a transition plan. If you look at the headings, you'll look at the governance, you'll look at the strategy, you'll look at the metrics and targets. But the important piece there in terms of the voluntary disclosure is that after this, you have a bit of the regulatory aspect coming in. So regulators are stepping in, and I think looking at the EU, we have the Corporate Sustainability Reporting Directive that is requesting the disclosure of transition plans. You also have the Corporate Sustainability Due Diligence Directive, also asking for the disclosure, but also the implementation. You just mentioned a bit of what's happening with the omnibus. So for our listeners, I mean, this can change, but the disclosure is going to continue to be an important part. It's not only restricted to the EU, we see this in other geographies. For instance, just bringing a bit of an example, so in Hong Kong for financial institutions, the HKMA, which is a monetary authority, is also requesting for the disclosure of transition plans in the planning process. So we're seeing a big movement in terms of really demonstrating the commitment and how you really get there.
Okay, so we are not beyond commitment, just demonstrate how to deliver concretely. And it's not just disclosure, but also market expectation. So one question is coming to my mind. What about the credibility of these plans? So can you just give us how to, let's say, have credible transition plan? What makes them credible, actually?
It's a great question, and not all transition plans are created equal. So the credibility side is really important, and as I mentioned, we have a bit of the regulatory frameworks, we have the voluntary frameworks coming in, and of course, these target different audiences from financial institutions to corporate, in a bit of a question, which one do we follow, what do we look at, what's the data point? So of course, the planning is important. So here at Natixis, we looked at, I would say there are around 17 plus frameworks and guidances in the market. So it's quite a bit daunting to go through. But if we really look at the credibility element, we're looking at ambition, which is the targets. We're looking at the action, which are the decarbonization levers that are going to be put in place. And we're also looking at the accountability, so the internal governance process to actually implement those plans. And I would say that within the planning process, to actually have a credible transition plan, a step back is carbon accounting. So looking at your emission sources, so your operations, scope 1 and 2, and also scope 3, because the transition is about the full picture. So this is also a key point in terms of the credibility, because then with this, you can set your target, really understand your material sources of emission and the direction you need to go.
And so you've mentioned the fact that there is a plethora of frameworks. So we can mention the Transition Plan Task Force framework. We can also mention the different guidance from the Climate Bond Initiative, the World Banking Alliance. Recently, the EFRAG also published some guidance to assess transition planning. So is there common element, or is it definitely different type of guidance, and how you deal with that in terms of assessing transition plan within Natixis?
No, excellent question as well. So if we look at the different guidances, I wouldn't say that there's a standardization in terms of what's being looked at, but because they will vary in terms of granularity, in terms of prescriptiveness, in terms of being 1.5 aligned or well below 2, or just in agreement with the latest climate science. But we do identify, and a bit of déjà vu here, 3 core themes. So the ambition element with the targets, so really having scope 1, 2, and 3 included, and the metrics, and of course, a time-bound frame, so if it's near, mid, or long-term. Then we have the action pillar, which is a decarbonization lever, which is important because if a company is just, providing a list but not really putting a time frame or a financial plan linked to that, it can be a bit of a red flag. And then we move to the governance process. So is there an incentive, or what's the internal process in terms of even the board oversight, the KPIs, linked remuneration to actually implement that plan? So these are a bit of what we see in terms of the headings in each of these different frameworks. The way that we're looking at it at Natixis is we're developing our own internal framework. And I think this is really important because what we're trying to do is to measure the transition potential of our clients. And by measuring the transition potential of our clients, we'll be better placed to support them in their transition journey. So the way that we're seeing it, and you'll see it in the screen, is you'll see 4 different pillars that we're working on. And as I mentioned, in terms of the credibility process, we're not reinventing the wheel. We're not asking other things that the market isn't looking for, but we framed it a bit different, I would say. So we're looking at ambition, and the ambition pillar is really looking at the target coverage. So if you're including scopes 1, 2, and 3, and if that's material, so really targeting the material sources of emission. So if, scope 3 is the material source and it's not included in your target, that could be definitely a red flag. Then we're also looking at the metrics used. So if it's intensity-based, if it's absolute emissions. And finally, we're looking also at the near and the midterm. And the criticism is if you look at the long term, then maybe you're postponing action. So if we look at the near and midterm, I think we can really measure how quickly this transition process is being taken into place and the potential. Then we move to the past and current performance, which is about how you're reducing and at what pace you're reducing your greenhouse gas emissions. And another important piece of the past and current performance is really about the revenue, so the share of brown and green, because with this you can also measure if you're going and if you're steering the resources in the right direction. Then the third pillar, and here I'd say this is once again the heaviest pillar in terms of the weight on how we're looking at it and assessing this, is the action pillar. And here we're talking about decarbonization levers, and the way that we're seeing internally and classifying these levers are looking at what needs to be exited, core decarbonization, diversification, and low carbon solutions. And thinking about the automotive sector, if we're thinking about phasing out its internal combustion engines, if we're thinking about core decarbonization, it can be green steel. If we're thinking about diversification, a bit of the obvious with electric vehicles. And if we're looking at low carbon solutions, maybe a bit of the automation tools that are being implemented. And then the final piece is the management of the transition, which is once again the internal accountability process. But here we're looking at how the transition plan is being steered, how there's incentives for the senior management to actually implement the plan. And also another important piece is the stakeholder engagement, because a transition plan won't be delivered by itself. So if there's a stakeholder strategy, and how do you engage with different stakeholders? And finally, I wouldn't say that this is not present in other frameworks, but the way we're seeing it is also the just transition element, which is a social element of the transition. And it's really key if you look at the affected communities, the workforce, so how companies and entities are addressing the just transition, and either by training or reskilling. So in summary, this is a bit of how we're looking at transition plan assessment. It'll become an internal tool, and hopefully we'll fully roll it out by 2026.
Pretty comprehensive and particularly ambitious. But even if a transition plan is robust, I mean, theoretically with the analysis that you could do, then we see that there is external challenges. We just see in the highlight the fact that the regulator is moving, is impacting as well. The supply chains are affected. So what are the main, let's say, challenges or uncertainties that could definitely affect the capacity to deliver and the robustness of the transition planning?
I think it's interesting, and I'll just take a step back in terms of the CDP has done a comprehensive report in terms of the transition planning disclosure and what companies are looking at, because this is a lot about the data that's being put out there. And it's important to flag that only 2% are listing all the indicators in terms of a credible transition plan. So I think there's a challenge with the planning itself. And then if we look at the numbers, around 39% are reporting around 2/3 of the indicators that the CDP is putting out as their credible transition plan. I've done an analysis. It's similar to what we're doing internally at Natixis. So I think it really says that there's still a big piece in terms of the carbon accounting, setting long-term targets, and one of the specific points is the financial planning. So how do you actually tie a financial plan to the decarbonization levers? And as you mentioned, there are externalities, and I think the World Benchmarking Alliance has been one of the institutions that has kind of made this more evident, because we know of the different externalities and the other frameworks. We're talking more about the structure and how you do the planning and how you actually public and disclose. But we have physical and non-physical externalities, and these are important because it brings a bit of ifs, right? So market forces and geopolitics and regulation can either speed or hinder the transition. If we look at also the existing infrastructure, it can influence if something is going to be deployed at scale or not. And even the supply chain, we've been talking a lot about strategic autonomy. So are the resources there? Are they available? And consumer behavior. So is there demand? Is there really a shift? So all this, even if you have a credible transition plan, you have these externalities that can affect how you are in fact going to deliver.
Thank you very much, Leisa. So transition will not be linear at all. We'll need to have adaptive transition strategy, definitely. Thank you very much. So now the scene is set. Let's start to speak, not in theory, but concretely with the automotive sector. So I'm happy to host our guest today to further discuss about this case. Let's start with you, Valentin. Let's say the basis with you. We just seen that there is some challenges, there is uncertainty. So can you illustrate a bit more what does that mean when it comes to the automotive sector concretely?
Yeah, first, thank you for having me on stage. And actually, I will take out one word from Leisa's pitch, and it was externalities. And the uncertainties on the automotive sector, in my opinion, are linked, or have a lot of link to these externalities. I would focus on two, the value chain, which is very important, and the public policies. On the value chain side, obviously, we are going to talk about China, definitely. When you talk about value chain, they are definitely leading the electrification game, and they are also controlling all the production or the refining of the parts that are the most important in the battery electric cars. And so on the leading part, basically China is much beyond its target in terms of electrification. While in Europe, for this year, we are expecting about 20% of electric cars to be registered. And in the US, we actually, they are unlikely to cross the 10% threshold this year in terms of registration of electric cars. When it comes to the supply chain, actually, China has the control on three key parts that makes the value of the battery electric cars, namely the battery, the semiconductors, and also the hot topic of the moment, rare earth. So ultimately, car manufacturers are dealing with that environment, trying to multi-source. So this is definitely costly, but this allows them to actually be more prepared when there is an issue with the supply chain, like with the rare earth. Sorry for that. And if there is a problem with a supplier, just to give you an example, like the battery manufacturer Northvolt that went bankrupt a few months ago. Secondly, on the public policies, actually there is one simple thing in the auto industry, is that this is capital intensive, so they need visibility to invest. And the thing is, with policies that are changing a lot these days, when it comes to the pressure of the regulations or the subsidies that are took out, and then we are discussing currently probability of putting them again, for example, in France or in Germany. This is not what the sector needs in terms of visibility, and this is also pressuring their transition planning.
Any other uncertainties that you identify on your side, Amaury?
Yes, thank you, Valentin, for this first elements, and I'm really happy to be here too. Maybe I would add some other elements more on technological part, I would say. You talk a lot about batteries. You're right. The cost of the batteries decreased a lot in the last 10 years. It's around 4 times cheaper on average compared to 2015. But if we are regarding the autonomy of those batteries, we see that it does no longer progress much. The city cars, for instance, for small cars, the autonomy is around 150 kilometers, and it does not raise much. And it's the same for bigger cars, which is above, of course, 350 kilometers, but it does not raise a lot. You mentioned Norvolt's bankruptcy, which it's obviously striking, but there is also the case of automotive sales company, the joint venture created by Total Energy, Mercedes, and Stellantis. They planned to build a gigafactory, but they have put it on hold until 2024 because they plan to turn to other battery models. And in fact, we see on this market that there are 2 technology of batteries that are competing themselves. On one end, you have the lithium iron phosphate batteries, which are cheaper, which are growing rapidly, especially in China, which is the main market for this type of battery. But the autonomy is a little bit lower. On the other side, you have the other type of batteries, lithium, nickel, and cobalt-based batteries, NMC and NCA, better autonomy, but for now, it's more expensive, and the progress on technological parts are maybe a little bit less important. Maybe we can have a word on the infrastructure also. On this one, I would say that in Europe, the EV charging stations are making progress rapidly. There is some different regulations that drives those infrastructures. The first one is the alternative fuel infrastructure regulation. Mandates the installation of fast charging station every 60 kilometers, at least on interconnecting highways. So it's more than enough for organizing a long trip with an electric car. There is also for residential building, the EU energy performance buildings, which drive the installation of charging station on this type of buildings. So I would say that in Europe, we are on track regarding the infrastructure. That's not the exact same case in the US. We see that, for instance, the subsidies for EV charging station had been paused by the Trump administration recently. And maybe to conclude on the uncertainties, I would have a word on the perception itself of the electric cars. When we are regarding what can be improved and what are the main needs for consumers, we see that the first break is the price. The price is the electric cars are still expensive. It's very difficult to find an EV cars below 30,000 euros on the new market. And for plug-in hybrid vehicles, it's even more expensive, sometimes around 40,000 euros. Maybe you can turn into the secondary market, but on the secondary market, we are still in short supply. The electric cars on the secondary market just represent 3% of the total sales. So the price is expensive, and the battery autonomy is still low. But on this one, I will be. It's a little bit less important. Just to say that less than 5% of car journeys exceed 200 kilometers. So only 5% of the total trips cannot be done with a single charge. So maybe we can rethink a little bit the role of the cars in that sense.
Interesting. Coming back to our question, actually, because there is plenty of uncertainties, but how companies are adapting? Because the transition endgame is still there. So how you see company concretely adapting their transition strategy, as we've seen? Are they really putting in motion the necessary adaptability and agility that we're expecting from them to keep this transition endgame. Do you have any concrete example?
Yes, of course. There's several ways which transition plan can be adapted within the automotive sectors. We can talk about the strategy regarding the number of vehicles sold. For instance, I saw Toyota, which initially planned to sell 1.5 million of electric vehicles by 2026, 100% fully electric, not plug-in hybrid. That was the initial plan. They first reduced this plan to 1 million in an announcement in last September. And more recently, it's finally 800,000 EV vehicles planned in 2026. Planned for 2026. Yes, it was announced in April 25. So number of vehicles sold, capex plans can be also adapted between low carbon vehicles and other type of capex. On this one, Ford, for instance, in August 2024, lowered the share of planned capex for pure EV. It was initially 40% the plan, and it's finally 30%. And they increase their emphasis on hybrids vehicle more than electric cars. So you can see examples in the Asian market with Toyota, in the America with Ford. On Europe, you have also the topic on the CO2 targets. The CO2 targets, which has to be lowered in 2025, sorry. And it is globally criticized by a lot of automotive manufacturers, and especially by the European Automobile Manufacturer Association, which is calling a delay to apply this reduction of CO2 intensity. So that's a different type of example. I would also say that, in fact, the pace of decarbonation of a certain company is highly dependent to other sectors of activity and geography. The geographies plays a key role as the number of electric vehicles increase. It's normal because the more you have electric vehicles on your park, the more you are dependent to the electricity, the carbon intensity of the electricity mix of the country. I made a short computation before coming here regarding a country where the country electricity mix is very low, in Sweden, for instance, and I take small electric cars, such as the Renault 5 electric, the last one. In Sweden, it's only 5 grams of CO2 per kilometers if we're regarding the mix of this country. You take the same car in Poland, where the carbon electricity mix is one of the highest in Europe, and it's more than 100 grams of CO2 per kilometer, 105 grams of CO2 per kilometer. So in fact, the geographies also can be adapted to maintain the track.
So if I correctly understand your point, globally they are pretty much adapting their strategy. Maybe quicker to name few car makers that are not doing so adaptation. So I don't know if you have any counterexample, Valentin, for us today.
Yeah, indeed, it looks quicker to name the very few that stick to their transition planning. And I would rank them in 2 different categories. The first one is the full electric car manufacturers. For instance, Tesla. They are not changing their mix because they have only one type of offer. The only thing is that they are paying it on their volumes currently. And you have also another type, which is the players that are, would qualify them as the multi-energy believers. For instance, BMW, for example, or Renault Group, that have not backtracked on their transition planning, or at least in terms of electric car mix. But this is also because at the very beginning, they have not planned a full transition to battery electric cars. Amaury was just talking about regions, and this is the main argument of BMW, focusing on each engine types depending on the regions. And in Europe, they are planning to go more on the electric part of the engines, while on some other regions like South America or Africa, they say we don't expect full electric cars to come in the near future. So we keep developing our engines that are not electric to supply these markets. Also, one thing we were discussing about car manufacturers. One word on the supply chain and suppliers, especially, and I think that they are most likely dependent on the orders of their clients, so the car manufacturers. Meaning that even if they have a transition planning, they are, and this is kind of an externality as well, they are dependent on the choices of their clients. And also, something overall, we are talking and heavily focusing on the products in this discussion. And this is for a simple reason, and this is all about the Scope 3 emissions, which are accounting for about 90% of the greenhouse gas emissions for car manufacturers.
And you mentioned the suppliers, so interesting to really open to the full value chain views. And let's come back maybe on the customer side. You mentioned that in the uncertainties regarding the demand side. So maybe interesting to see what could be done, because they are also facing these type of uncertainties. So interesting to see what could be the lever and the let's say the agility needs that we have on the customer side and the demand side as well.
Yeah, in fact, on the demand side, the first step will surely be to bring affordable models on the market. And on this one, I think that 2025 will be the year of the release of such models. Renault with the Renault 5 Electric, Citroën, Stellantis with also city cars, the Fiat Panda. All these models will be proposed for less than 25,000 euros at the entry level. So that's a new step for the popularity of electric cars, especially the city cars, which is highly favorable for electric technology and the moderate autonomy. So affordable vehicles is one way to stimulate the demand. I think that we can also have a look on the public subsidies, the leasing model especially. On the leasing model, first exercise was set up in France in 2024. It had to be stopped because it was kind of victim of its own success. But we saw different studies on that showing that subsidies per vehicle, single subsidy per vehicle in Europe could cover a large part of modest revenue to own their own electric vehicles. So you have the leasing model. You can find other mechanisms at a public level to stimulate the demand. The scrappage bonuses, for instance, the electric bonuses compared to thermal one. All of it are effective measures that are compatible with such demand stimulation.
Thank you. Maybe to sum up, can I ask you in one word to share with us your level of confidence on this capacity to adapt transition strategy for globally the automotive sector? Maybe starting with you, Valentin.
I would be rather on the optimistic side, I'd say, and in my opinion, the auto industry is all about crisis management, just in time, and flexibility. So there's a lot of uncertainty behind that, but if I had to rate on a scale of 1 to 5, I would give it a 4 in terms of confidence.
Amaury?
Can I have 3 words instead of 1?
Okay.
For me, it's biggest technological revolution for the automotive industry. So I would be a little bit more pessimistic. I would give it a 3 out of 5. We have no background on such move in this industry, and as I've said, it's highly dependent to other sectors. So 3 out of 5.
Thank you very much. Thank you very much to all of you for this insightful discussion. Our next Green Up TV session is scheduled on July 11. And you can find all the Green Up TV replays on our YouTube channel, especially the last one on the ESG backlash. Stay tuned.